Hello, my name is Eddie Tofik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London UK feed wheat. Hello and welcome. Before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of the patterns, levels, or analysis on any of the related items on these, my charts. This was all my own original work, as I think you deserve to have that. So with that, Paris milling wheat. There had been here in the past one dominant pattern over all this market that 26 weeks ago took a break on the downside. I'll still mention it now because it's important. You can still see it in the top left hand corner of my daily chart. It is of course the late August 24 to late February 25 ascending triangle pattern. This pattern had the requisite combined 5+ touches and is made up from a lot of smaller patterns within it, but parts of the main pattern can still be seen. 26 weeks ago I laid out targets below for this pattern of a primary target down at 226 and a secondary harder to reach target down at 194. 25 weeks ago markets reached the primary target, but we kept shying away from the 200 level enough that I chose 10 weeks ago to retire the secondary target at 194. We then started forcefully approaching that 200 level again in early August, and I started wondering whether to reinstate that 194 target. 2 weeks ago those thoughts became moot as prices reached down and managed 194.25 and last week went fully below it. The latter part of this week sees the market now starting to stabilise below 194. In the meantime, my thoughts and attention were drawn to other interesting patterns. The first had been the bright red, once more realigned March 24 today uptrend, currently at 193.25. This has been tested a number of times, eventually giving way each time since its establishment back in late May. It did hold this time over 2.5 weeks of mid-August, but it has seemingly given way. Well, it looks like it might have given way this week. There's definitely a breach on the downside. Importantly, back 5 weeks ago, I said about how back then the now important purple middle time, currently at 201.25, of the mid-March to mid-May bearish shift pitchfork had, now remember, this was back 5 weeks ago, and I quote, runs through the bright red uptrend late next week. And if there was ever a time when you could knock out two supports at the same time, then that would be it. So I advise caution ahead of a possible further testing on the downside, end of quote. I'd gone even further 8 weeks ago when I said, and I quote, I'd watch this bearish shift pitchfork, especially the middle time, as we seem to be running out of time. You see, what I mean is that the middle time crosses down through the bright red uptrend at the end of July, and I suspect before then something will have to give. Add to this the pressure above from the medium moving average, that's currently at 207.25, and the static 50% absolute Fibonacci line. It may be that we'd see a test down towards the July 21 low at 197.25, end of quote. Watch this space, and then the end of the quote. All these came together 4 weeks ago, and we are seeing the resultant move, follow-on move lower to all this over the last 3 weeks, plus this week. We may possibly carry on lower in the weeks to come, but we have done a lot in a relatively short amount of time. So we still have to look to the downside, and apart from the already mentioned levels, we now need to look at the March 2021 low at 191.75, which has been tested yesterday and again today, plus the purple lower time currently at 189.75, along with the nearby congestion at 190.5. However, if these downside levels are breached and broken, then the very existence of the battered bright red uptrend will be at stake, as the next support is the origin of the uptrend itself, which is the March 2024 low itself at 187.75. Thus in all this, keep an eye throughout on the bearish mauve shift pitchfork, as it is running the show right now. Minneapolis wheat. The sideways triangle over February to May had run this market lower by mid-May, but we then saw the bullish impact of the slightly realigned dark blue September 2019 today uptrend, currently at 576.75. In mid-May, originally way below the market, it was being tested and holding, as it also seems to be doing this week, along with the help and possibly now the hindrance of the congestion at 578 3/4. Now back then in mid-May, those together turned prices higher in mid-May. The market rising up to the important July 23 to date downtrend, currently at 632. And that was in mid-June. It peaked there and again in early July for a second time, together creating a very lopsided late May to mid-July head and shoulders top. Since this creation, prices had a devil of an effort pushing down below the bright red neckline for this pattern, currently at 595 1/4. But they eventually did so in late July and eventually let go of this downward sloping neckline this week, it seems. I surmised last week that this holding on might be a function of the steep nature of the bright red neckline. I still think that was and is true. Now, I said 5 weeks ago, and I quote, for a break low we would have a primary move below the neckline of 23.5 cents. The secondary harder to achieve move of 50 cents. But add a caveat to the full move lower to watch out where the September 2016 to date uptrend is at the time, as I think that might lead to a possible higher secondary target. End of quote. Looking last week with a break below the bright red neckline, hopefully even now that it still isn't a false break, though today's potential for a daily key reversal up I note, and also, yeah, that's there. I gave a primary target X below in the 580 zone and a secondary harder to reach target X1 down in the 555 zone. So how did this fit in with the supports below? Well, target X is very interesting as it was just above the historical congestion at 578 3/4. Plus, with the rising September 2019 to date uptrend currently at 576 3/4. Now, it was also achieved this week. Below this, we have a lot of support just after it, including lows nearby in March, May, and January this year, and also earlier in November and December last year. So you can see there's a lot of supports below. However, all that being said, we are also possibly on the threshold of a really big pattern, a December 24 to date possible cat's ears pattern. This is a bearish pattern. But the discussion for this, which I have postponed for a couple of weeks, may be coming up, and really soon. It's not going to happen today, as we're about to trigger the downside opportunities for such a pattern. It is a longer term pattern, but I urge you to keep remembering this idea as we travel and stabilize a little lower than where we are. I may feel obliged to deploy it once it happens, along with its ramifications. The only other feature I'd like you to draw your attention to is the lagging indicator. It's a dead cross of the green short medium moving average down through the not so declining but still declining mauve medium moving average. London UK feed week. Okay, so there had been on this daily chart until early July and running for about a year now one major significant pattern here, a pattern that we have not seen in the other grain markets. I still have this on my daily chart for a reason, and the pattern is the bright red late May to early July 2024 bearish shift pitchfork. In early July, due to changeover, we had a very large gapping move higher up and out of this pattern, beyond the bright red upper time, which is currently at 166.20. Now please remember that level, and also the bright red upper time, as it will show up again shortly. Now, added to this upper time, we had higher up the important, even today, 50% absolute Fibonacci line at 180.5. You had there, and even now still have, an area overhead that is significant resistance, as it capped the market on its rise back in July, with some added nearby help at the time from the purple July 23 to date downtrend, currently 181.5. Since that peak, we've seen prices ease lower. 2 weeks ago, down below the gold long moving average, currently 170.20, and a 50% Fibonacci line, the May 24 to July 25 move at 169.70, and finally start to test the combination of the May 23 low at 168 even plus the previously mentioned bright red upper time, broken bright red upper time, and the very, very important dark blue neckline extension. And that's to a pair of very long-term patterns which that neckline I will detail now. Both these long-term patterns neckline are currently at 168.10. This leads me to my final 4 points, the same 4 points I've been discussing for months now. And 3 of them were something that I noted back in my annual commentary back in January this year on London Feed Week. To see these, it's best if we switch to my longer term monthly charts. Firstly, I saw back then the potential for a very large May 2023 to date cat's ears pattern. This is a bearish pattern akin to a double top, formed after a big fall, such as the fall we had earlier in 2023, and then the double top, as well as an even longer term second pattern, an August 2020 to date very large head and shoulders pattern. So shoulder, head, shoulder. These two super long-term patterns both rely on one single feature, and that is their common neckline, highlighted in purple on my monthly chart. Currently 168.10, the same as on the daily chart I just spoke about. Thus the primary target X3 for the bearish cat's ears pattern will be down in the 127.5 zone, just below the bright red and big old 2005 to date uptrend, currently at 131.60. A secondary harder to reach target X4 will be down in the 112.85 zone, around where the dark blue lower trend line is, currently at 113.90. And that's for the 2007 to 2022 ascending expanding wedge pattern. For the head and shoulders top, we would have an even lower primary target X5 down in the 64.20 zone, close to where sits the oldest uptrend I have on any of my 200 or so charts. The 1975 2-day, yes, half a century old uptrend, currently at 65.95. I'm not even going to give you my secondary harder to achieve target for this pattern as it is below zero. Please, please, please bear in mind that these are very long-term targets stretching possibly over many, many years, but they are still targets below for these patterns above. And until something else happens, they will stay there. Now, that all being said, July with changeover threw a major spanner in the works for such long-term patterns. The reactionary, immediate countering monthly key reversal up for July went back above the purple neckline, but stopped at the 50% absolute Fibonacci line at 180.5, and just under the newly drawn 2023 to date upper bear channel line, currently 182 3/4. The question this posed, and it's a longer term question, is whether this was just a reactionary single month move higher or the beginning of something else. For now, I will continue to stick to the reactionary single month move higher, but I am prepared to start looking at the possibility of a new base of support, not only being built, but also being exploited for a possible move higher. There is one caveat to this basing higher idea, and it's one I've already mentioned, and that's the newly drawn mid-23 to date big bear channel. It's currently 134 to 182 3/4. Even with such a big reactionary move back up, we are still sitting within this big bear channel. And it does have the advantage of already having had at least the minimum five touches necessary to legitimize it. For all this discussion, we are still dealing here with some very, very long-term patterns. You should please bear that in mind. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.